Good afternoon, everybody, and welcome to the Spirit Telecom Investor Conference Call. It's just kicked over 12:31, so we will begin. Before I do that, I do want to welcome all our retail investors. I do also want to welcome prospective investors, and I know there are a number of Spirit institutional investors who have joined the register over the last 3-4 months, which is a tremendous result given their support. So I'd like to welcome those institutional investors to the call as well. Okay, just to our first slide. It's been quite a strong and very successful week for Spirit. I just do want to reflect on the last week and mention some of the events before we do discuss the accomplishments of FY20, but also focus on where we sit here today in FY21. So for those who aren't aware, we released record results early last week and then moved straight into a trading halt. The rationale and reason for that trading halt was that we raised capital through a placement. We also allowed our retail investors to be part of an SPP, and we acquired at the same time 3 companies in New South Wales simultaneously to allow us to grow that market instantly. So that was quite a successful week for Spirit, and we're here to discuss those elements. I've got Paul Miller, who's our Chief Financial Officer, who'll talk to some of the rationale of the capital raise, how the balance sheet is actually looking. And at the same time, if you're interested, you're allowed to, and obviously we encourage you to put through Q&A on the right-hand side panel as well. So I'll talk to the numbers, the strategy, the rationale for the acquisitions, and then Paul will talk through some of the financials, and then we'll summarise. We should be finished by 12:30. So quick summary of FY20. Obviously revenue was up just shy of $35 million. I guess really proud of the EBITDA result, because you can grow revenue, but if you haven't got your economics right, that certainly doesn't help you. So EBITDA came in very strong at 88% increase on FY19. More importantly, our recurring revenue or contracted revenue made up 67% of that portfolio. So if you think about a COVID environment where there's volatility in economics, that is absolutely vital. And as you can see, our strategy on B2B has meant that we've seen growth of 140%, just shy of $29 million on the B2B side. So that, I think, transformational year. It was a year where we effectively transformed the business from a high-speed internet company to what I call a modern telco, having a range of products. But I think the right-hand side of the screen probably tells you where we are sitting here today, which is more exciting. I'm really pleased to announce that, conservatively, our current run rate, is in the $80 million mark. In terms of our current balance sheet, we've got $36 million in debt and equity at our disposal, and Paul will talk to that in a minute. And we've had a tremendous fast start, both organically and through our VVD acquisitions, with around 2.3 million in sales just in July. We also launched our brand new national advertising campaign across Sydney, Brisbane and Melbourne. And as always, we're very active on the acquisition side. But what you've seen from myself and Paul and the executive team, we're actually also becoming professional, and we execute very well in integration. So of the last acquisitions that we completed, 5.5 of the 7 have already been integrated fully, and that's very, very important. So we're not just executing acquisitions and M&A, we're actually integrating those organisations, and the economics are flowing through. So for those investors who are not familiar with the stock, I urge you to have a look at where we sit here on the 88 mil run rate and the strength of the balance sheet coming through in terms of opportunity. Just on to the next slide, really trying to paint a picture of what I call the aisle. So the best way to explain what the organisation is becoming, and is pretty close to becoming, is the office works of telco and IT. And over the last 12 months, as well as providing exceptional returns to shareholders and also increasing revenue by 100% and EBIT by 88%, what we've actually done is created a modern telco with key aisles. So I would urge you, and I've been trying to explain this for 12 months on PowerPoint, and to think about the paradigm shift and the structural change shift that's currently occurring across the world. If you don't think the IT and telco industry is emerging, well, you're not sitting on the same Zoom call as I am currently. You haven't been on the same Teams calls as I have over the last 6 months. You haven't been on the same Google calls. The two industries emerging, and Spirit has inserted itself at the forefront of that across Australia. It's done that by obviously having its original high-speed internet through its own network and a third-party platform. We are now the largest aggregator of B2B. We now have managed services, we have a security layer, we have our own voice platform running at margins of 80%, and we are one of Microsoft's leading cloud providers. Additionally, we haven't just expanded our market, we've also created a defensive market. So on the left-hand side, the original business, Spirit IT&T, very strong industrial and parks and office. We're now a leader in private schools, we're now a leader in commercial industrial. We do work for Australia's leading hospital groups. We even go down mine pits and provide managed Wi-Fi in there as well. So not only have we expanded the product set, created a digital platform, but we've been very defensive and strategic with these products and services. Just to explain the economics, if you said 12 months ago, one contract for high-speed internet was $15,000 to $20,000, that's all we did. Now, IT support can be an additional $20,000 a year. Security can be 5 to 20. Voice can be 35, and cloud can be another 30. If you add those up, you have yearly contracts with clients between 50 and 100,000. The economics is better. The client gets a better value proposition. They also get the ability for their workforce to work remotely, but it's also economically better and it reduces churn. If we're able to keep clients on 3 to 4 of those products, reality is they don't move. It's just almost impossible for them technically to move. So the economics are better, the product offer is better, but also it reduces the churn. In terms of, and I talk about this a lot, and this is important for analysts and investors to understand, what you currently have is the merger of two sectors. So I don't see Spirit Telecom just looking through the lens of telco. We are now a telco, but we're also now an IT services company. But what differentiates us? Well, what differentiates us is we can merge the products into a bundle. We can execute them for our customers. And then over the top of that, for our partners and our resellers, we have all our data products in one digital platform. And the latest capital raise and the VPD acquisition will allow us to put all of those products into our digital platform to resell. So you have an organisation now that's not only transformed itself, it's inserted itself into a structural change and is executing to what the market needs, which is bundled products and services in a market that has been expedited through COVID. In terms of the problem we're solving, well, we are innovative. You know, we do have the most modern product range in IT tech in Australia, but sometimes it's all about timing. It's also about what your competitors let you. So the problem we're solving is that large organisations, large telcos, and if you look at their results, they haven't been able to adapt to what is a fundamentally changing environment in the needs for businesses, as for schools and education providers and hospitals. We need those range of services from one provider. What it actually is about is modern products, digital distribution, but old-fashioned service, right? And disrupting that particular market and taking market share, because they're not doing the right thing by businesses, they're not doing the right things by schools, and in that lies the opportunity. In terms of Q1 and Q2, I'll talk to the strategy in a moment, but we're now really on a very aggressive distribution hunt. So we've signed more, we're close to 30 in the last week, but we signed a number, we've got about 170, we're probably up to just shy of 200 now, solution partners and resellers. What they are they could be an old photocopy dealership, we retrain them, they could be a system integrator who resell the most modern product range of telco cloud services. They do that via our digital platform, which is SpiritX. I'm proud, and we've talked about this already, this platform was launched only in December and January, and we've had 12,000 unique leads or inquiries go through that platform already. And that's before we've launched our mainstream marketing campaign. So on the right-hand side, you can see the benefits of that. We've got the right distribution partners selling complex products on the ground at long contract lengths, but we're also doing it through digital innovation in a platform play. If you want to see the retail version of SpiritX, just go to spirit.com.au, go to connect and check your address. There's over 3 million locations. So the theme there is, in 2020, you don't need to own all the infrastructure to make good gross margins. And we've disrupted the industry using digital. And that is our own intellectual property, built over the last 12 months. If you think somebody else can do it, well, I can tell you it was bloody hard, and we own the IP. In terms of the last acquisitions, we really wanted to push into Australia's largest market, both by GDP and opportunity in New South Wales quickly and immediately. And we had many options in terms of, so that's one of the great scenarios which changed for us in the last 6 months. We have providers who want to come to Spirit and be part of it. We've got quite a unique acquisition model. I call it a buy-in model. All the vendors stay. They do have a wealth creation moment for them and their families, which is important, but they come on a bit of a life journey with us as well to disrupt the telco and IT industries. So we acquired 3 telcos. If you map them, they're almost a triangle of New South Wales, 1 in central New South Wales and 2 in Metro Sydney. What does that give us? That gives us instant coverage of New South Wales, both in terms of the engineers on the ground, but also it supports all those 21 partners that we've signed who are going to be selling the most modern product range. So the other part that I just want to touch on, which is critical, we pay at 3 to 3.5 times. The large deal we did recently was at 4, maximum up to 4.5 and 5. So that is very critical. We're using shareholder money wisely, right? And that's coming back our returns. We're de-risking it so we don't have write-offs in the future when we've overpaid. We do not overpay for assets. We're patient and use those funds. That's why the right-hand side, we had an amazing response to our placement and not heavily discount placement from a number of blue chip institutions. And we raised $18.3 million, 360 of that is through management. Very proud that the management has also invested in the company. And also we took the opportunity to reward our small shareholders. In the last 6 months, we've brought in about 600 retail shareholders to the register. So we're bringing, all of Australia and institutions onto the register. Why is that important? Because a lot of those are business owners. So what they're going to do is be part of a journey to disrupt IT and telco, but they're also going to share, right, both on the equity side. So I'm pretty proud of that as well. Just in terms of how we phased it, we're very strategic. We don't play checkers, we play chess. Right, and we did that through the VBT acquisition in July, and all of these were planned and phased. VPD gave us an entire wholesale channel of those 21 resellers. That also gave us about 15 mil of revenue and really strong EBITDA. And then we followed that up by effectively putting a puzzle together. And what we've done is then given all those partners that VPD are signing up and has already, engineers and businesses. So not only are those businesses accretive, but they give us scale all across New South Wales, and they did it instantly. Now, we couldn't have done this without the experience. Remember, for those who aren't aware, we started small. We only acquired these small types of organisations, and they're not that small, they're 3-4 mil, but provide 2.5 EBITDA 12 months ago. We've learned, we've gathered a lot of our IP. So now we can be ambitious and do simultaneous 3-way deals of this type. And we've also brought really good people to the team. At this point, I'll hand over and I'd like to introduce Paul Miller, our Chief Financial Officer, to comment on our current capital situation, and obviously our balance sheet, and just a run over the FY20 year financials. Over to you, Paul.
Yeah, thank you, Sol. So as Sol mentioned, Spirit is in a very strong balance sheet position. We have projected access to approximately 36 million in available capital, that is shown in the graph. Specifically, the group has circa 4.1 million in cash on hand at this point in time to manage our routine operational working capital requirements. Again, as Sol's already outlined, we have 17.3 million in net proceeds from the recently completed capital raise. So this was comprised of an unconditional placement to institutional and sophisticated investors, and that settles tomorrow. And we have a further conditional placement to directors and management, again, as Sol's outlined, of about 360,000, which remains subject to shareholder approval. In addition, at this point in time, we have 9.6 million of debt facility headroom. As we previously announced, the CBA increased the Spirit debt facility by $5 million. Which lifts that overall facility limit now to 15.9 million. That facility is currently drawn by 6.3 to therefore get to where we are at the moment at 9.6 million available. Existing retail investors will have the opportunity to participate via a share purchase plan, which we forecast to raise up to an additional $5 million. The SPP opens on this Friday, the 28th, and runs through to the 15th of September. So when you put all those pieces of the puzzle together, we have a very strong capital position to execute on the group strategy moving forward. So next slide. So the next slide is our year-on-year revenues, which I'll address sort of the year-on-year revenue growth as part of the revenue mix slides that are coming up further down in the pack. So we go to the next slide. So the next slide is addressing our underlying EBITDA. So the FY20 underlying EBITDA grew 88% from FY19 to where it is now at 3.73 million. And this equates to approximately 11% of the total FY20 revenue. We are targeting to scale from 11% to 15% over the course of FY21 to get to an underlying EBITDA run rate of 15% by the end of FY21. Some key points of interest to note is that the FY20 EBITDA shown only included contribution from Cloud BT and the Trident and Neptune group acquisitions that we undertook from February 1st of February 2020 onwards, so 5 months only. The last 3 New South Wales MSP acquisitions that Sol addressed generate approximately 11 million in combined revenue with an EBITDA of 2.5 million, which equates to a 21% margin. So that puts those in context. And a portion of the capital that we raised is being allocated to accelerate the synergies through automation and gross margin improvements. So we're targeting circa 1.5 million in OPEX synergies, which will be progressively delivered over the course of FY21. So the combined business accelerate the opportunities for economies of scale and also the bundling of solutions to deliver material gains to the EBITDA contribution level moving forward into FY21 from where we are in where we ended FY20. So next slide. So Sol outlined the total revenue was up 100% on FY19 to $34.9 million. So of the 34.9 million, 23.5 is classified as recurring, and the remaining 11.4 million we classify as solutions and project-based revenue. So for FY20, the recurring revenue represented represented 67% of the total revenue, and it grew by 48% on FY19. As I'll outline in the next few slides, there is a strong growth in the B2B recurring customer base, which is up 75% on FY19. So some additional highlights and FY21 considerations is that the 3 New South Wales MSPs that we recently acquired, which are generating the 12 million, as I mentioned, their recurring revenue base is greater than 60%. And as announced in July, more than 85% of the BPD Group's revenue is recurring, and they have a very high retention rate. So taking into account the new acquisitions, the FY21 indicative recurring revenue percentage is in the forecast range of about 50 to 55%, which shows the blended group moving forward. Next slide, please, Sol. So B2B year-on-year revenue. So this graph that's on the screen outlines the growth in the B2B revenue on a total basis. Sorry, Sol, I think you skipped one, maybe go back. Yep, so total B2B has increased by 147% to 28.9 million on FY19. So this demonstrates the ongoing growth of the business in the target markets that span SMBs, verticals across education, health, aged care and mining. The B2B customer base, as Sol has also mentioned, is diversified from both a geographic and an industry perspective. And the customer base is resilient, continuing to deliver demand in challenging times. In regards to the solutions and projects revenue, which has expanded to 10.2 million, it's important to acknowledge that this revenue is generated from a sticky customer base. So the majority of the S&P revenue is shown in this graph was generated through the Trident Solutions Technology Business Unit. So Trident's core customers have a relationship that spans 7 to 13 years. So the solutions and project revenue, although we don't classify it as recurring, is in one sense underlying recurring, given the goodwill that's accrued through through customer service and solutions that have been provided over a prolonged period of time. Next slide, Sol. So before handing back to Sol, yes, this slide sort of sums up the ongoing changing mix of the customer base that I've referenced. Of the total FY20 revenue, 84% related to the B2B customers, which was up 17% on the comparative in FY19. With the recent acquisitions, that mix is progressively increasing and now represents 90% of the revenue base. And the customer base is accelerating investment in cloud-based IT and internet solutions. And the opportunities to serve those customers with bundled offerings is likewise accelerating. So back to you, Sol.
Thanks, Paul. Well done. I'd just like to, before I finalise this slide, I certainly would encourage you to put forward questions. I will try to answer as many as I can. If not, I just want to remind you, you can obviously go to the Spirit Investor Centre on spirit.com.au. It's to your right-hand side, and put any questions going forward. All our current videos are in there as well, so you can go from there. So to conclude, from my side, in terms of the 2021 outlook, I'm really proud to be sitting here with a strong balance sheet, organic growth running at a run rate of $80 million, and I do think that's conservative. Aggressively having distribution partners all over Australia being signed to sign our product range. Our last acquisition, our most material one, performing very well. Obviously, having the courage and the ambition and also the confidence now to be doing simultaneous acquisitions to give us market share, because we do want to attack aggressively the major telcos, because we think they're not executing in the market very well around this modern product set. On the M&A side, look, we couldn't be in a stronger position. 36 mil of capital to be deployed, 5.7 of that for 3 acquisitions. If you do the numbers on it, really it was 5.7 mil of cash for about 2.5 of EBITDA. So it's almost 2 times on the cash side for those acquisitions. So it gives us enormous upside to get to our 15%. We've obviously got a higher target, 50% normalised underlying EBITDA for 21. And the pipeline of acquisitions grows. But I think history will tell you we're patient. They have to fit into our strategic plan. We have to be very diligent on the due diligence of the people we bring in the organisation. And I've said this before, we recruit people and profit. And when we do deals, they're a 1 + 1 = 4 or 5. They're not a 1 + 1. On that note, I thank you for your time, and I will move now to Q&A. If you just give me a minute, I will run through the questions. Okay, first question is from Brad. I'll repeat it. Where do you see the business in 5 years' time, and how big? Look, Brad, coming from my private equity days, I only really look 12 to 24 months out. I think that given how quickly the market changes, I can give you my 12-month view is we will continue doing what we're doing, which is pick up right-sized M&A acquisitions, probably in the 10 to 30 mil mark. Probably at 100, maybe 200 mil, there are larger opportunities for the organisation to scale much quicker, but it has to be in the interest of shareholders. We get approached, but it has to make sense. So sorry, Brad, I can't give you 5 years out, but I think if you look at the last 12 months, you should, and I know there's a lot of shareholders who've been in the organisation for many, many years. I think if you look at the last 12 months, I think on par, we've been one of the fastest growing IT and telco companies on the ASX. So growth is there, but it'll be clever growth and it'll be at right prices. Next question, no name there. Is the 35 mil of acquisition targets revenue, can it be funded from the current balance sheet? Yes, it can. I think that's all the actual questions we have. And I obviously thank you for your time. I know get a hand up. More questions coming. So I've just got to wait for them to come through. Okay, here they are. Okay, from Mayo, have a question is about your cloud infrastructure. Do you use your own cloud servers? Can you tell us a bit about the location? Sure, fairly technical questions. Yes, we do. We use our own servers, but we lease the actual racks. And we're one of Australia's leading providers. We have a license with Microsoft that allows us not just to use our own cloud infrastructure. Microsoft has allowed us to actually have those to choose, depending on the customer's demand and the gross margin, to actually serve that on Microsoft Cloud, or we can use it on our own infrastructure as well. Okay, final question. What is the objective of the national marketing launch? Really good one, Deb. So the objective is we're now seeing media discounts somewhere between 50 and 80%. We've just acquired, I'm able to buy, would you believe, mainstream news media at 80–90% discount, which is distressed. So the reality of it is there is no better time to deploy capital to build a challenger brand in IT and telco for businesses in Australia. So, you know, we're getting, you know, we're literally getting for what cost $100,000, we're getting 3–4 mil of value in terms of what we would have paid 3 or 4 years ago. So it's quite simple. You advertise, you get leads, and sometimes the answer is really simple. The opportunity is to sell more stuff to more people. It's nothing more complicated than that, but also build a brand and build an asset and fulfill those leads. On that note, I will end. I'm grateful for everybody making their time. I'm looking at the participants. We have an amazing response. Once again, thank you. I wish you well during these times. And if you do want to, please follow up at spirit.com.au Investor Centre. Thank you again, and goodbye.